Welcome here to the Moore Building and for our winter event, for our holiday event. I'd like to, my name is Jeremy Schwartz. I'm the board chair for the Economic Club of Miami and one of the co-founders. I just want to extend to all of you a warm and generous thank you for joining and for being part of this club. When people talk about what it really makes up the Miami miracle, well, you guys are it. You really make Miami what it is. It's the people, the talent, the energy. So we're very grateful for you joining us tonight. We're also grateful for all of our partners, and we're of course very grateful to our speaker, Michael Saylor, for joining us for an important discussion. Again, obviously in the holiday spirit, we have Hanukkah and Christmas coming up. So this is especially appropriate now. 2026 offers to be a very exciting year. And so we thought this would be a wonderful event for all of you to listen to what Michael has to say, to ask questions, and for all of us to learn, to grow, and to exchange ideas with one another. So a big thank you for all of your gracious hosting and presence. And just so you know, this area we still have access back over in the bar area and obviously at the other entry points. I would like to turn this over to our executive director and a dynamo in the social media space, Francisco Gonzalez, to sort of run this out, okay?
Thank you, Jeremy. And thank you, Jeremy, for having the great idea to be one of the co-founders of this club 4 years ago, putting Miami even more on the map globally. So yes, as you mentioned, I'm Francisco Gonzalez, Executive Director of the Economic Club of Miami. We've really been growing like crazy, as you can see. We just can't even fit people in the room anymore. We're gonna have to get bigger rooms. But I did want to make a mention. We now have over 340 active members of the Economic Club of Miami. And there's many people here tonight that this is their first event as a member. So if that's you, I'd like you to please stand. And I know there's some already standing, but thank you. Well, welcome. Okay, now down in front from the cameras. We have just a great event tonight, and it wouldn't be possible, again, without the support of our members, but also some of our sponsors. So first, we have an amazing sponsor host of this place here, of Oshaka Miyama here at the Moore, and that is William Siepking, and I'm going to bring up William to give you a nice welcome as well.
Hi, how are you? Welcome to the Moore Building. Our objective here is to build a platform for entrepreneurship, a platform for Miami to compete against the big cities of the world that are Dubai, Abu Dhabi, New York, etc. I think that we're doing an amazing job. I think that we have a bright future. And I always say, it's time to shine for Miami. So thank you for coming. Thank you, Michael. And Francisco, we have been collaborating with the Economics Club for a long time. It's a great community, and enjoy the evening, and welcome to the Moore Building.
Thank you, William. Again, thank you again for supporting this event. So now I also want to say thank you to one of our members, Craig O'Sullivan, who's up here, and Craig will be interviewing our featured guest tonight, Michael Saylor, who probably doesn't need any introduction, but I'm going to do so anyway. We do have people on YouTube eventually. So Michael Saylor is an American entrepreneur, executive, inventor, author, and philanthropist. He's the founder and executive chairman of Strategy, a publicly traded business intelligence firm that he founded in 1989. Dang, I think I was playing Nintendo then. And it wasn't connected to the internet, whatever that one is. Which holds 3% of the total 21 million Bitcoin supply, making it one of the top 5 global investors in Bitcoin. Michael's also become one of the biggest ambassadors of Bitcoin on the planet. He's also the founder of Alarm.com, named inventor on 48 plus patents. We'll get you to 80 soon. And author of the book, The Mobile Wave. He founded the Saylor Academy, a nonprofit that has provided free education to over 2 million students. He's an advocate for the Bitcoin standard. You can find that at hope.com, with dual degrees from MIT in aerospace engineering and history of science. He posts his views on X at Saylor, S-A-Y-L-O-R, and his website, michael.com. His 4-hour interview with Lex Friedman summarizes his thoughts on Bitcoin, inflation, and the future of money with 11 million views on YouTube. We'll try to get you a few more views tonight, and now I'll turn it over to Craig O'Sullivan.
All right, great. Thanks, Francisco. Well, welcome to the Economic Club of Miami, Michael. We're delighted to have you. I know this has been a long time coming, but we're definitely appreciative of your time and the fact that you're willing to meet us here in this rather small and intimate setting. Certainly you're used to the larger conferences, so we appreciate your versatility. So on Friday, NASDAQ announced that MSTR would remain in the benchmark NASDAQ 100 index. So congratulations on that news. Your response on X was that Bitcoin hoarding will continue until the complaining stops. Can you explain a little bit of the backdrop on why you posted that?
There was just a snarky headline in Reuters where they said Bitcoin hoarder strategy remains in the NASDAQ 100. And it was like fake news because there was never any intention of removing us from the NASDAQ 100. And it's kind of like it's a backwards kind of insult to suggest that the company just hoards something, and just reminds me of what is the insult of people doing anything intelligent that you don't understand. You just call them hoarders, like the people that hoard food when everybody else is starving to death or whatever. They think you might need it. But yeah, we're not a hoarder. What we are capitalists. So the most fundamental premise is Bitcoin is digital capital, and a lot of the traditional finance establishment doesn't understand capital, and so they don't recognize a capital asset when they see it. So we're acquiring Bitcoin as capital the same way that you might acquire 3% of Manhattan. So say you believed in Manhattan and you go and you buy up 3% of all the raw land in Manhattan, right? They would call you a Manhattan real estate hoarder. But it was never our intention to hoard the real estate in Manhattan. It was the intention of people that bought up Manhattan to develop a great city. And eventually you build buildings on that real estate, and the buildings have cash flows, and those are credit instruments. So our company believes Bitcoin is cyber Manhattan, right? It's a place that one day everybody on Earth will want to put some of their money. We think it's the greatest city in cyberspace. It's the greatest digital property. Just like if you go to Manhattan and you ask people that live in Manhattan, they think that their city is the greatest city, not just in America. They think it's the greatest city on Earth, and people have been buying Manhattan real estate since 1650. Every decade for 300 years, and they keep paying more than the previous decade paid, and it's never been a bad idea to buy Manhattan because it is the greatest city. So, but no one ever called a Manhattan real estate developer a land hoarder, I don't think. Maybe they did, I don't know. But we think that Bitcoin represents the apex property of the human race, digital property. And our rationale is, if it is the apex property in cyberspace, it represents economic spectrum. It's like, once upon a time, people bought up all of the radio broadcast rights over the United States. And you might have called them, spectrum hoarders. But without the spectrum, there would be no AT&T or Verizon. You can't have mobile phones. So you need the spectrum. And so we view Bitcoin as like economic spectrum. And we think it's just going to get more scarce and more valuable over time because there's a lot of money in the world. And as people want to move their money in cyberspace, either through cyberspace or into cyberspace, they're going to want to buy up that spectrum. And so our company's been accumulating it with an eye toward developing it. And there are a lot of ways to develop capital. If you had $50 billion of capital, you could use it to launch a commodities exchange. You could trade derivatives. You could use it to underwrite insurance. Insurance companies have capital. You could turn it into a bank. and you could use it to buy consumer loans, or you could buy commercial loans. We have chosen to use it to create and sell credit. Another way to say it, you've heard of annuity companies, companies that actually create annuities. You can buy an annuity, they'll pay you 7% or 8% or 6%. We're in essence creating annuities. And the most famous one is STRC. And it basically is a digital credit instrument that right now pays 10.75% dividend yield monthly in cash. And the way we do it is we invest that capital into Bitcoin, which is appreciating faster. And we scrape off the first 10.75%. We pass it through the credit investors. And because we are the capital investors, we hold the capital, we take the long view. And if you have enough capital, and you have a long enough view, you can strip the volatility and the risk off of the instrument and off of the credit investor. 80 or 90% less risk, 80 or 90% less volatility, and you can extract the dividend or the annuity stream they want. The remainder goes to the equity investor. And generally, if you were in the business of creating annuities for people, you wouldn't just call the company a Bitcoin hoarder, right? Any more than you call, the related company a land hoarder. Right? That's not what they do, right? They're creating buildings for people to live in. And
But you're a hodler for sure.
Yeah. We're just believers. Again, just like if you ever met someone in Manhattan, you ask them if they're ever going to sell their apartment, they're like, sell it for what? Like literally people that have a nice piece of real estate in Manhattan will say, I'm giving it to my heirs, and they'll give it to their heirs. It'll be in the family for the next 100 years, because every place on earth is a step down. And all you got to do is go talk to someone that's a big New Yorker, you'll hear that over and over again. So our view is, this is the apex property, so we're going to develop it, and we're going to enhance it over time, but no, we're not really looking to sell.
So today you announced another acquisition, another purchase. I think it was about 10,600 Bitcoin. And when you announced on a Monday, though, that doesn't mean that you bought it Monday. That means it could have been from the last week or so, correct?
Yeah, we normally announce those things over the course of a week. So on Monday morning, we'll announce what we did in the previous week. This week, we announced something like, $960 million worth of purchases. But a week ago, we also announced about 950 or 960 million in purchases. So about $1 billion a week for the past 2 weeks. So this announcement was everything we did Monday through Friday of last week.
So what factors do you consider when making these purchases?
We buy Bitcoin whenever we have money. I would say tongue-in-cheek, I only buy Bitcoin with the money you can't afford to lose. So this is the 90th purchase. And so we've done it 90 times. It's a very simple way to think of it. So Bitcoin's been going up about 45% a year for the past 5 years. I expect it to go up 30% on average for the next 20 years. It was going up 80% on average 5 years ago, so it's decelerating from 80 to 70 to 60 to 50 to 40, and it should continue to decelerate, towards something like 1.5x the S&P. And so it's not hard to get to a forecast of about 30% over 20 years. But that being the case, the way I think about Bitcoin is it's a digital monopoly on capital. It's the world reserve capital network that's growing 30% a year that you can purchase at 1 times revenue. So if you're the CEO of a company and I came to you and said, I have a monopoly that's growing 30% a year for the next 20 years, and you can buy it at 1 times revenue, the question is, would you do the deal? And of course, the answer is everybody would do the deal, right? If anybody ever said, I have a company growing 30% a year for the next 20 years, and they'll sell themselves to you at 1 times revenue, you're like, well, why are they so stupid? Like, no one's ever that stupid. The last time Google bought a high growth company, they paid 27 times, 30 times revenue, 10 times revenue. Normally you pay 10, 20, 30 times revenue for a high growth company. So a high growth company that'll sell itself at 1 times revenue is a pretty extraordinary deal. Now, for us though, it's a much simpler decision. It's not just a monopoly growing 30% a year for the next 20 years that we can buy at 1 times revenue. We can buy it risk-free. Okay, well, why can I buy it risk-free? Because my company is constructed for Bitcoin maximalists. The only people that buy my equity are people that believe Bitcoin is going to win and is going to grow 30% a year. If you didn't think Bitcoin was going to grow faster than the S&P index, there's no way you would buy MSTR. Okay, if you thought, that might have been a debate back in 2020, but after the company bought Bitcoin 89 times in a row, if you're still holding the equity, you have to believe in Bitcoin. So when we buy Bitcoin, we've already stripped the existential risk off of the investment. What matters is not whether anybody else in the world thinks Bitcoin is risky. What matters is, do my equity investors think Bitcoin is risky? And so I'm doing an acquisition which is by definition accretive without risk, and I'm getting the deal at 1 times revenue, right? And we're creating a very transparent credit profile, a very transparent performance profile, and that means that our hurdle rate is 30% risk-free. So, if you were to pitch me anything, if you said, I have the best startup idea ever, I guarantee you 40% a year for the next decade, I would think that's not as good as the deal I have buying Bitcoin. You could promise me 50% a year for the next 20 years. We wouldn't do the deal because I would have to convince 100 outside equity investors that your deal is better than Bitcoin, and I wouldn't be able to convince them, number one. But number two, it would be a dilutive distraction. So we have a very simple business model. It's just we just buy Bitcoin. We expect 30%. We know it'll be volatile. It'll be 30% with 30 vol over 20 years, and right now it's 40, 50 vol. And if you have the ability to just keep doing the same trade over and over again, it makes sense. You could think of it as, maybe one of the all-time great roll-ups where you're just rolling up, a digital asset with a limited supply, and every time you buy a bit more, there's that much less supply in the market, the scarcity goes up. The risk doesn't go up because, let's face it, if Bitcoin goes to 0 tomorrow, it doesn't matter whether I own 1% of it or 2% or 3% of it or 0.5% of it. It's irrelevant, right? I mean, it's kind of like back to the Manhattan example. If you've decided you believe in Manhattan and you bought 1% of Manhattan, you might as well buy 2 or 4, because if Manhattan sinks under the ocean, you're going to be bankrupt regardless, right? There's nothing you can do if Manhattan sinks, beneath the earth. But, once you've accepted that as the systemic existential risk, and your opinion is Manhattan is not sinking beneath the ocean, then, you've already got a basis, in the city. You've already managed the rest, and the least risky, most accretive thing you can do is just continue on your strategy.
At the Cantor Crypto Conference held here in Miami last month, you mentioned that there are 2 important days in everyone's life: the day they're born and the day they realize why they're here. When did you determine your calling, and how were you certain that it was your existential purpose?
What's interesting is we discovered Bitcoin during the COVID lockdowns when the world turned upside down and interest rates went to 0. And I would liken it to, say you owned $500 million of real estate in a city, and there was a pandemic and the mayor took over, and the mayor decided to reduce all rents to 0 forever for the public good, and then just sent you a memo saying, we expect you to accept 0 rents on your building forever because otherwise you're a bad citizen. And if that happened to you, and if the building was still worth $500 million, you might think, I'm going to sell the building and move to another city where I get respected a bit more because this is offensive, right? Or you could stay in the city and accept 0 forever and go bankrupt, and then people will just ridicule you for being stupid, and you went bankrupt and you probably deserved it. So we got to that point, and I thought, well, the cost of capital went to 0. Jerome Powell literally said, we're lowering interest rates to 0. I'm not even thinking about raising interest rates for 4 years. Like, you go see the press conference. So At that point, I had 500 million, and I thought it's either a fast death or a slow death, or we're going to have to move, take a risk. We're going to have to transform ourselves and fight our way out of this. So we decided to take our 500 million and buy something where it wasn't rent controlled to zero. And we started looking for a capital asset that was not already highly appreciated. And what I wanted was something like gold, a cross between gold and a monopoly on a digital monopoly. So I wanted like the Facebook of money, or I wanted Google for money, or Microsoft for money. The best investment ideas have been these, the FANG stocks, now Mag 7 stocks, but FANG, Google, Apple, Facebook, Amazon. I thought, can I actually buy a digital monopoly on capital? And Bitcoin looked like the best aspects of Google or Apple, and it looked like the best aspects of gold and a non-sovereign store of value bearer instrument. And I thought, I kind of like the idea of you have portable capital. I give you $1 billion, I drop you in Africa, and I say, buy anything you want, you got to hold it for 30 years. There's not a single thing you would buy in Africa. Not a company, not an index, not a credit instrument, not a currency, nothing. And you wouldn't buy $1 billion in gold because they wouldn't let you out of Africa. They'd steal the gold, right? And so the issue is, what are you going to buy where you need to move the capital asset, right? In the Middle Ages or the Renaissance, people bought art. You know, they bought very, very valuable art from the Italian masters, and they bought it so they could run for their life when they had to flee the city-state when they were the minority. So the struggle for portable property goes back, thousands and thousands of years. It's always been a human problem. So we thought, Bitcoin looks like portable property, but it was digital, and if I had gold. And gold was like portable capital for thousands of years. Like everybody agreed that gold was capital for thousands of years. Even people that wanted to kill each other and hate each other, and they couldn't agree on anything else, they could agree that they wanted to kill you for your gold. Which, by the way, is it's a big deal because in South America, when the Spaniards show up, the Aztecs, the Incas, they didn't actually think of gold was money. The Spaniards did, and they brought the gold back to Europe, where everybody the Spaniards wanted to kill also agreed it was money. And so it was a big deal that people agreed that gold was money. But if you had a genie and 3 wishes and you said, how do you make gold better? You would say, well, first I want to make it impossible to mine any more gold and cap it at 21 million gold coins. And then you would say, I want it to be weightless, invisible, and I want to be able to teleport it. And then the third ask would be, I want to make it programmable so the billion AIs can transform it 1 billion times an hour and send it to another 1 billion computers, and I can put it on 8 billion iPhones and Android phones because that way everybody is going to have this powerful thing, and maybe it'll transform itself in 3,700 iterations over the weekend and make you a lot of money. That's not going to happen with gold. It's not going to happen with real estate. It's not going to happen with soybeans. It's not going to happen with art. It's not going to happen with credit portfolios and security portfolios. So I thought, a digital monopoly on capital asset. We're going to take our 500 million. We're going to buy it. And it was first we were, I would say, was out of desperation and frustration. It's like someone told you you're going to die, and you're like, okay, I guess I will flee for my life with whatever I can take. And then it became opportunistic because the stock tripled, volatility went through the roof, and we could borrow money for free. And so if someone wanted to give you $1 billion for free for 5 years to invest in your business, would you take the money? Yeah, it's like after we were just about to go out of business 6 months earlier, we thought, okay, now someone's going to give us $1 billion for free. We're going to go buy Bitcoin with this money. So then we became the biggest issue of convertible bonds in the world, and we issued like $10-12 billion of them, and we worked that. But ultimately, I would say that was the opportunistic phase, and in that phase, the product was the equity, and then the tactic was the credit. But we went through these iterations, challenge and response, and necessity is the mother of invention. And so when we borrowed senior debt, we had EBITDA covenants that choked us to death, and so we couldn't do that anymore. And then we did asset-backed financing where we pledged the Bitcoin, and then the bank failed, and the Bitcoin crashed, and that created hysteria, so we couldn't do that anymore. So then we did $10 billion of convertible bonds, and then we maxed out the convertible bond market, and all the convertible bond buyers ran out of money. And they literally didn't have any more money. We'd just taken, too much of the market. And along the way, I learned a lot. I got a PhD in leverage, and what I learned, I became very, when you borrow money and your bank fails, you learn a lot. By the way, it's much better that way than if you get margin called by a bank that's collapsed. That's much better than getting margin called when the bank is healthy, because we got to buy the loan back at a big discount. But I became very disenchanted with corporate bonds and 144A offerings. For those of you who don't know much about it, a 144A offering is an over-the-counter bond issue when you sell it to a bunch of institutions. And it's a really fancy term, and they make it sound good, but here's what it is. It's like one dude in a back alley trading between 37 guys' baseball cards. It's an awful market. Okay, so over-the-counter bonds mean, you can sell 500 million of bonds. They're liquid. The bid-ask spread is 3%, and they trade 30% cheaper than their fair value. And so I learned, I didn't know anything about this before I got started, but we worked our way through, and I just realized that you're not going to grow the business, and there's no future if you're selling bonds over the counter through the convertible bond market or even the junk bond market. The credit, and then I became more of a, first I didn't understand capital until, a near-death experience, and I had to think about money. Then I didn't really understand bonds until we had worked our way through every part of the bond market, and then I just became very critical of the bond market. I just realized it was crippled. And it occurred to me that most corporate issuers of bonds are issuing crippled instruments for that tactically in order to fund a project, but the credit itself is not good. It's not good to own it. Like it's an awful. If you had a bond that was worth $100 and it traded at $52 and it was illiquid and only traded one day a week, that's not good for you, right? And so we decided that we needed something more scalable, and we went to the preferred equity market, and we created a preferred equity instrument to raise money with the idea that we were going to put together every good idea we'd seen, and we're going to duck the bad ideas. And the good ideas are take the credit instrument public, give it a happy 4-letter ticker, give it a name, let the retail investors and the public investors buy it. The difference between over-the-counter and IPO, over-the-counter means it's illegal for you to buy this instrument. The securities law make it illegal for a normal person to buy it. You have to have $100 million. And let's say you had $1 billion. You still can't buy it unless you actually have an account with the bank that's selling it. Okay, so if I wanted to make it insanely difficult to buy something, I would do it that way. Public means that 200 million people can buy it in 10 seconds. Okay, so it's not like one is a little bit better than the other one. One is good, the other is awful. So we decided we were going to sell a credit instrument to the public. We're going to IPO it. We're going to put it on NASDAQ. But then you think, well, I can't have a 5-year bond that I take public because in 2 years or 3 years, the duration won't be long enough to make it useful. There's not enough liquidity. So we wanted to make it public. We wanted it to be perpetual. We wanted to put a shelf registration on it so we could sell it. There are days when we would sell $45 million worth of this credit instrument in a few hours. We just liquid sell it. We could sell $50 million a day, $100 million a day, whatever. You can't do that with an OTC bond. So we put a shelf registration together with a preferred equity, took it public, backed it with a digital capital asset called Bitcoin. And and then we discovered, we didn't want to pay the money back, right? Because if you're going to borrow the money to invest forever, you don't want to pay the money back. So it turns out that credit investors like to be paid back. And if you don't pay them the money back, they require a higher credit spread. So we ended up, selling these things and offering a 10% dividend at par. And I thought 10% was a lot. And then I thought about it and I realized, well, we're collecting 30%. 10%, if we pay 10 and we collect 30, if you work out the math over 10 years, it works out to 90% of the economics go to the common equity investors and 10% goes to the credit investor. And that's a pretty good deal for the equity. So we paid a bit more, and the bug became the feature. And then we discovered that we had inadvertently created the world's best credit instrument. And the product is not the equity, the product is the credit. Because the product we created is a thing you can buy online like STRC that'll pay you 10, say it's 10% dividend. It pays you a 10% dividend, and it's a return of capital, so it's tax deferred. So that if you're a New Yorker, it's like a bank account that pays you 22%. If you live in Miami, it's like a bank account that pays you 18%. And of course, who wants a bank account that pays them 18%? And I'm like, yeah, right? Of course, we all do, right? Because currently the money markets pay you 370 basis points and it's taxable. And that's the best it's ever going to get for you, because if you go to Europe, it's 150 basis points. And if you go to Japan, it's 50 basis points. And if you go to Switzerland, it's minus 50 basis points. So now we get to the final punchline, like why were we here? Well, here's what we realized is we can create digital credit and we can strip 80 to 90% of the volatility off of Bitcoin. We can strip somewhere between 80 and 90% of the risk off the instrument. We can pass through 10% or 9 or 11 or 12% return, and we can make it tax deferred. And there's a $300 trillion credit market, and that digital credit pays you 2 to 4 times more than every other type of credit. So if we do that, no reason why you can't just digitally transform 5% of the market, and 5% of $300 trillion now is $15 trillion. It's a lot of money, but by the time we get there, presumably the market's doubled and it's $30 trillion. So it's insane. And then I'll make one more point and I'll stop for your next question, which is I first realized that Bitcoin was digital capital, but digital capital is like, it's like you got a 3-year-old kid and you give him $1 million worth of real estate in the middle of Brickell. It's dirt, no cash flows. And in 30 years, maybe it'll be worth a lot of money. And if you want to get cash flows out of it, you've got to form a real estate development company. You got to design a building, get a construction loan, build the building, market the building, rent out the building, deal with all the politics and the maintenance, and then maybe you get some cash flows. But not easy for a 3-year-old kid. Not easy for most 30 years old. So if you go to the same kid and you say, or the parent, you say, I'll just give you a credit instrument that pays you $10,000 a month forever, starting now. Okay, well, how many people would prefer to have the credit, right? By the way, the world is, even if the capital asset's going up 30% a year, the better deal is take the capital asset, but most of the people, they can't wait 20 years or 30 years with no cash flow. They want the money. So it turns out that converting capital into credit, that is the mission of the company, in the same way that a real estate developer takes a bunch of raw land and turns it into a building, and either the people are living in the building or the person that's collecting the rents is getting paid some steady income. We realize that we're kind of put here to create that digital credit, and that digital credit is then the stepping stone to the final thing. And the final thing is digital money. And the idea of digital money is not 10% dividend yield with a 10 vol. It's 8 or 7% yield with a 0 vol, right? What if I give you a bank account that pays you 7 or 8% with 0 vol? You put $99.71 in, you get $99.71 out, but until you take the money out, you get 4% more than the risk-free rate in the currency that you live in, right? That is the perfect product. I submit to you, I used to think the iPhone was the perfect product, but the iPhone, you got to actually be able to hold it and look at it, and you got to be awake, or maybe be able to hear, or be able to see. But a bank account that pays you 8% or 7%, you could be deaf, dumb, blind, in a coma, unborn child. You still want that. You want that for your heirs not born for 20 years, right? So what is it that everybody on Earth wants, right? And you know, in the English language, there's a word for what everybody on earth wants, for universal utility, and the word is money, right? You want money. Okay, when I give you a bank account that pays you double what SOFR pays you, if I give you double the money market, or if I give you, you live in Japan and I give you 6% or 8% in yen, I'm literally just giving you free money. Okay, I know it sounds difficult. It is difficult. It's like building nuclear reactors in order to give you free electricity or 1 penny a kilowatt hour electricity. It's hard, right? You basically have to create a layer of digital capital, not our doing. Then you have to create a layer of digital credit. It takes a lot of equity capital, right? We have 60 billion now. We'll probably have the most digital equity capital in the world forever at this point because no one's going to catch us on this network. And if you have that credit layer, the last layer, digital money, can be created by partnering with a bank or a money manager. Like you just basically go to a large bank or a BlackRock or a Vanguard or the likes, and then you create 80% credit, 20% cash equivalents, put a 10% buffer of currency reserves on top of it to strip the last vol each day. And you have just put shock absorbers on the credit. And the credit is, of course, sort of like damped, volatility stripped, risk stripped capital, right? And that's the 3-step process. So the day I realized why I was here is I realized we're here to fix the money, right? We're here to give 1 billion people a bank account that pays them 8%, when the rest of the world wants them to take nothing, right? In Switzerland, nothing, right? In Japan, nothing. In Europe, 1%. In the US, about to be 2.5%. When the Fed lowers SOFR to a 2-handle or something, you will be getting 2%. And the actual increase in the monetary system is like 7% a year for 100 years. So if you don't beat 7%, you're just getting poorer in relative basis. And right now, the only way for the average person to beat that is to gamble. You have to gamble on equity. You have to guess. And I'm of the opinion, when you're a 70-year-old retiree, you shouldn't have to gamble. You shouldn't have to gamble on equity. It's not right. Right? The entire world somehow decided that capital was buying the S&P index, right? You have to buy a portfolio of equities. And what about just giving people a savings account that actually preserves their wealth and they don't have to gamble on equities or the like? And so that's what we're here for, right? We're digitally transforming the credit markets, but the big idea is fix the money in the world and fix the money with technology.
Amen.
Yeah, that's great. And you've already discussed some of this, but maybe you can expound upon it for the next question. Last week, when you were in Abu Dhabi for Bitcoin Mena, you mentioned Satoshi Nakamoto's idea that the future is corporations holding Bitcoin to create high-powered digital money. Can you explain the playbook that a bank or a nation state should follow to achieve this?
Yeah. So, and this is an observation we first got to. When we created Stretch, it was like a Bitcoin-backed T-bill, like a 1-month T-bill. And the idea was we modify the dividend rate to strip the maximum volatility off it. And it looks like right now we can probably get that instrument to somewhere between a 5 and a 10 vol. Like it's probably going to move between 97 and 100 or 98 or 99 and 100, but we're never going to get it to 0 vol by ourselves at the credit layer. So, and we pay a monthly dividend. Well, the ideal thing would be we pass it through to a bank, First Bank of Abu Dhabi or Emirates Bank or Bank of Bahrain, or you could do it with Morgan Stanley or JP Morgan. You do it with any bank. And the bank strips the last 10 points or 5 points of volatility off it by putting a small currency reserve on top, and then you can draw down the reserve. If Stretch is trading 99, you just draw down 10% of a reserve. If it's trading 98, you draw down 20%. When it bounces back, you replenish the reserve, you take some of the dividends, you put them into the reserve, and you just keep this reserve buffer. It's like a shock absorber on a car. Like, how do you get a car to like roll smoothly over a bumpy road? You need some kind of shocks on it. So that's one thing that you do, but you need a partner to do it. You need the counterparty. You can't do it yourself. The other thing the bank does is you convert monthly dividends into daily, right? So you create a daily dividend stream. The third thing you do is you deal with liquidity fluctuations. So maybe you could make it 50% credit, 50% currency equivalents, or 80% credit, 20% currency equivalents, but you actively manage the currency layer. And by currency equivalents, I mean like 1 month treasury bills. You put that in. And so if you get hit with you got $1 billion fund and you get hit with $100 million of redemptions in a single day, you sell the currency, you don't sell the credit because the currency is 1,000 times more liquid, 10,000 times more liquid than the credit is. So you sell the currency in order to avoid pushing the NAV up and down. And so the currency is a liquidity buffer, and then that reserve is the volatility buffer. And through active management, you convert a monthly to a daily thing. Then you put it on a platform, rebrand it, and then the last value added is get the regulator to approve the thing, to green light it, right? And so what I'm describing is digital money. If you can create it in the form of a coin, by the way. You can create a stable coin type instrument that pays 8%, but you would need a digital assets regulator to approve that. Imagine stable coins that paid 8% backed by Bitcoin, right? That would just eat the world, right? If you do it in a fund like an ETF, like BlackRock or Vanguard do all the time, that even JP Morgan has money market ETF funds. If you do it in a fund, you need a securities regulator to approve it. And then if you do it in a bank account, you would want the banking regulator to approve it. So if you want to create high-powered digital money, right, the idea is it's perfectly pegged to the dollar. Or you could do it in the yen or the euro too if you want to peg it to those. But at the end of the day, somewhere in the range of, it could be as low as 60, as high as 80% of all the capital in the world really wants to be in the dollar, right? So that's the big kahuna here. So you peg it to the dollar, you put it on the platform, you actively manage it, and then you reduce that that last volatility level to 0. At that point, you've got the platform, you've got the sales force, everybody's got all the big banks in the world, they either have a big sales force or they have a big platform that they can move it on. And I think the real challenge, it isn't going to be technical at all. It all comes down to regulation, and the countries that are most advanced are either going to be UAE, Bahrain, or the USA. I think that the Swiss are way too slow. Singapore's lost its nerve. They're not going to do this. The Chinese are more interested in control than they are in innovation. The Europeans more interested in control than innovation. The Canadians, the Australians, they'll wait. So the competition to create the world's greatest digital money, the first digital bank that offers a digital money account that pays you 400 basis points more than the risk-free rate, that will be determined somewhere between the Middle East and here, depending upon the conviction, right, and the clarity and the ambition of the individual actors. And obviously, I don't think everybody will do it at the same time. I think someone will do it, right? And what's the play? Like, what I said to and I met with a bunch of banks, all the sovereigns in the Middle East, I said, the $200 billion idea is you take your sovereign wealth fund and you either buy digital capital, digital credit, or digital equity. If you don't trust anybody, you buy digital capital, right? If you think the credit markets are broken because 3% or 4% isn't really enough, then you buy digital credit, right? And And then if you believe in digital credit, you could buy the digital equity. That would be like my common equity, MSTR, or the equity in another Bitcoin treasury company creating credit. And there's two others right now. There's MetaPlanet and there's Strive. They're also creating digital credit. But that's the big idea. The bigger idea is you have your bank start to custody Bitcoin. And then there's $2 trillion worth of digital capital out there and is unbanked, and so you'll have hundreds of billions and eventually trillions of dollars, and that's like a $2 trillion idea. You create the digital credit by extending credit on the underlying capital, and that's a bigger idea. But the biggest idea is ironically the simplest idea. Like, a lot of people don't want a nuclear reactor in their backyard, but they want free unlimited electricity. And if I said, hey, my state has free unlimited electricity, you know, not 1 in 100 people would say, well, how did you get free unlimited electricity? They would just show up for the free unlimited food, free unlimited. I mean, free unlimited generally is a very good marketing point, and people they very seldom say, how did you make it free and unlimited? But they think that free and unlimited is good. So no one would complain about the nuclear reactor in the desert if you gave free unlimited electricity. And so in this case, the crypto world oftentimes, you know, they want you to learn to do very complicated things. And in the Bitcoin world, we would say you got to study it for 100 hours and you got to rethink economics and rethink politics and rethink monetary theory. And somewhere between 100 hours and 1,000 hours, you get it. But the average person doesn't want to spend 100 hours or 1,000 hours. They just want something quick and easy and free. Okay, so the $20 trillion idea is very simple. We have a bank in the UAE, and the bank has a digital bank account. If you want to put your money in a conventional bank account, we pay you 3.5%. And if you want to put it in a digital bank account, we'll pay you 8%. Okay, what's the catch? Well, you have to believe in digital assets, right? You have to believe in digital capital and digital credit. You're like, well, I don't know. I mean, is it safe? Well, let me give a different analogy. Conventional money markets are like trains, right? You move a lot of stuff over a train track, you know, and it's steel rails. And digital money is like airplanes. It's like airlines. They're made of aluminum. They shake a little bit, make a little bit of noise. They go up, they come down. There's 2 pilots. You know, people worry about it. You know, it's like, and you know, it's not for everybody. You'll move a lot more freight on a train or maybe a container ship if you like. There's slow, there's faster, there's fast. But in time, enough people fly around on airplanes and we get comfortable with airplanes, and you know, there are advantages to airplanes. Like we can go from here to Singapore, and it's hard to get there on a train, right? It's hard, you know, it's like people used to go, the safe way to travel was on a ship to Europe. 'Cause, you know, it's like, well, that's the conventional way, but at some point, right, I mean, you got to move on to the new thing. And so the digital idea is you just, you know, if you go through the process of create the digital fund, put it in a digital bank, that's very simple. There's $200 trillion worth of bank credit, money market credit. Like, why do people buy corporate bonds or junk bonds? Not because they want the bond, it's just they don't want to get paid nothing. Right? People take credit risk for yield. People take duration. Why do people buy a 10 or 20-year bond? Not because they want to wait 20 years to see if they get their money back. They buy it because it pays more than the 1-month bond. If I didn't have to take duration risk, and if I didn't have to take credit risk, and I just got paid double, you know, junk bonds only pay you 5% in Europe, right? The credit spread between investment grade bonds and sovereign debt is 70 basis points. It's what they call return-free risk. Right? Another way to say it's all garbage, okay? Like most conventional credit, it's all it's illiquid, it's got no return, it's got a huge amount of risk. People don't really want it, it's just there's nothing better. So you give someone a bank account that pays 8% backed by digital capital, what happens? You slurp $20 trillion into your bank. By the way, that second idea, have the bank custody Bitcoin. That's a good idea for crypto billionaires. The crypto billionaires send their money to UAE because now they can get a loan at SOFR plus 50 basis points on their Bitcoin. That's a good idea for crypto billionaires. The third idea, digital money, account that pays 8%, that's every billionaire, right? That's just everybody, even the people that hate Bitcoin, even the people that don't know what it is. Everybody with money, small, mid-size, large, it's a bank account that pays you 8%. What do? I'm just going to wire you billions and billions of dollars, of actual dollars, from Australia and Canada and Singapore. And if the Chinese would let me, I would wire it out of China, but they won't let me. But it will flow from every market where there is an account with control into the bank. And so what did I tell them? I told them, you want to be the Switzerland of the 21st century. Switzerland's not going to be the Switzerland of the 21st century. They've already missed it. Right? If you want to be the banking capital of the world in the 20th century and draw tens of trillions or hundreds of trillions of dollars eventually into your country. And I said, you don't want the people, you just want the money. Right? Like think about this for a second. Right? If you could just have all the money of 1 billion people come to your country and the people left behind, you're better off. That's the idea, right? Don't draw the human capital, just draw the capital. And the way to draw the crypto capital is create crypto credit. You custody Bitcoin. The way to draw all the capital is create digital money. Right? It's like, you know how to operate airplanes. I'm afraid of them. There's a fire in the jet engine, right? It's a fire. You know how to operate nuclear reactors? No one really, they don't care that they don't know how to refine crude oil or create explosives or build airplanes. They don't care. All they know is the United States is the most powerful country on earth, and so therefore they trust us with their money. And so this is an arms race for the future of money. I don't really know who will win it, but my money is somewhere between the UAE and the USA. Believe it or not, the USA was behind regressive and getting worse 15 months ago, and we have flipped. And so, it's not clear to me that one USA bank won't get there first. You have a very supportive head of the SEC. You have a very supportive head of the CFTC. You have a very supportive head of the Treasury and the banking apparatus in the United States. Between those three, I don't think there have been 3 more progressive regulators working for a more progressive president in the century, right? Not in a long time. So the U.S. definitely has a fighting chance, but Abu Dhabi's got a lot of very aggressive people. They like digital technology, they like money, and they know that there's no way. By the way, if you go to Abu Dhabi and you go to the top floor of ADIA and you look down, the Sovereign Wealth Fund, and you look down, they're building Manhattan in the desert. Their aspiration is to build Manhattan in the desert, and they know you're not going to do it without a lot of money and without taking risk and being progressive. Other places, they don't feel the need. I think the Europeans feel like they've already got it covered. They're all fine. Right? And others don't feel the need, but in UAE, actually, they have ambition and they know that they can't play it safe. They're going to have to embrace new ideas. I think they're the first city talking seriously about licensing air taxis. Wow. Right? I mean, and so there are a lot of Rorschach tests, that tell you a lot about a culture and the attitude of the people and the way they deal with technology and whether they think it's an opportunity or it's a threat tells you a lot about the society.
So last week, Strategy sent a letter to global index provider MSCI, that's Morgan Stanley Capital International, challenging its proposal to exclude digital asset treasury companies from its stock market indexes, which are used as industry benchmarks. A decision is expected next month. So can you walk us through some of your concerns and what a successful outcome would look like?
I'll just make a point to start though, which is, the crypto industry struggled against being debanked, for the entire history of the industry. This is just, it's a politically driven action to sort of debank digital assets companies, but really just block them from an index. It's misguided. It's a little bit politically motivated. It's probably being fed by short sellers, but it's not. It's a third order issue. At the end of the day, it won't matter one way or the other because, if the index decided to drop companies with intellectual property, it wouldn't stop streaming video and streaming music. And if you look at the entire capital market, their idea is if you have more than 50% of your assets in digital assets, maybe that might be an issue for them. But every successful company in the world has more than 50% of their assets in some kind of asset. You can't have an airline without airplanes. You can't have Disney without theme parks. You can't have streaming music without streaming music rights. You can't have Verizon and AT&T without Spectrum. You literally can't create mobile communications, right? So every one of you can't have real estate companies without real estate assets. You can't have oil and gas without oil reserves, and you can't have timber without timber reserves. So in essence, the proposal is a bit confused. I don't know whether they'll go through it or not. I mean, I think we're engaged right now to point out to them that it's irrational and it's a little bit prejudicial, right? What they're really doing is they're blocking the development of the digital assets industry. But it's happened, we've struggled against this in our industry. When we first announced we bought Bitcoin, our insurance company dropped us. Right, we got de-insurance. I actually had to underwrite the D&O insurance for my own company for 4 years, and it took in essence, I don't know. We had to, after we made $50 billion, they decided that they would start insuring us again, and now the insurance companies insure us. The banks didn't bank the industry, and that changed. The accounting profession had accounting, which didn't allow us to ever make money. We could only lose money. It was literally toxic accounting where you had to take every loss, but you could never show a gain ever, and that was fixed. So we've had hostile tax, hostile accounting, hostile banking, hostile insurance, and hostile media coverage. This is funny, I'm not going to mention the newspaper, but you can guess. We announced we bought Bitcoin, our stock quadrupled, and the first story was crazy CEO risks his shareholders' money. It's working for now, but we'll see if it crashes eventually. And then the stock went up by a factor of 10, and it traded down 40%. And they wrote a story: CEO bet, Saylor bet billions on Bitcoin and lost. Right? That was the second story. And then the stock went to 140 billion, and then it traded down to 70 billion. And after we had actually increased our enterprise value by a factor of 100, the story was, company lost 70 billion over the past year. So it was 3 negative stories in 5 years in the time period when the digital assets, when the people that bought Bitcoin made $2 trillion. They managed to avoid the $2 trillion capital gain, the $100 billion equity gain. And so all of these industries, they all have a hard time with the new idea. Eventually, they embrace it. With MSCI, I don't know, we'll see. I mean, their idea is like companies shouldn't own digital assets, and I think that they're studying it right now. I think they'll get a lot of feedback from a lot of investors, from a lot of companies, from a lot of policymakers, and hopefully they'll take the rational course forward. But it doesn't matter at the end of the day. It's like someone saying, I heard that one of the indexes didn't want to have real estate companies in the index. It's not going to stop people from building real estate because the real estate is necessary. If they dropped insurance companies from the index because they had capital, by the way, you can't have insurance without capital. If they dropped the banks because they had capital, it wouldn't stop banking and it won't stop insurance. And in our particular case, it won't stop the advance of digital credit, because at the end of the day, the problem you're solving is how do you give someone a bank account that pays 8% or give them a credit instrument that pays 10% that's tax deferred. right? And that problem, digital credit or the opportunity for digital capital, is much bigger. You know, the index will either do the right thing or it will marginalize itself by doing something which, you know, misses the next billion people's interest.
All right, final question. Do you think Bitcoin's 4-year cycle is dead?
Yeah, I mean, I think there's this is repeated ad infinitum, and, you know, 4-year cycle, 4-year cycle, 4-year cycle. There are certain tropes that keep getting repeated. I think it has its origins in the fact that, you know, Satoshi implemented the halving. 50% of all the Bitcoin that will ever exist was mined in the first 4 years. And then there was a halving, and then 25% came in the next 4 years. And then there was a halving, and then 12.5% came. So one can certainly argue for the first 12 years, it was supply driven because the amount of Bitcoin being put on the market was large by the miners. And then each halving event cut that supply in half, and then it, you know, then it went to 6.25, whatever, and then it went to 3 1/8 or something. And so we're at the point right now where it's become somewhere in the range of I would say, a second order to a third order driver. The actual liquidity in the market, you know, depending upon your estimates, is like $20 billion to $50 billion are the estimates of daily spot liquidity, and $100 billion of derivatives liquidity a day. The Bitcoin being mined by the natural miners is 450 Bitcoin a day. So at current prices, you're talking about $40 million. So $40 million of supply coming on the market each day versus between 20 billion to $100 billion of trading. It suggests to you that the supply side is not driving the market right now. And if it was, and that's the only argument for the 4-year cycle really, it's being overwhelmed by other structural developments. When, if you think about the annual supply at 450 Bitcoin a day, you know, you're kind of you're in the $16 billion to $18 billion worth of natural Bitcoin from natural sellers available to sell each year. So every time someone buys $16 billion worth of Bitcoin, that's one annual supply. So my company bought more than that. BlackRock's buying more than that. If JP Morgan turns on credit, they will issue $16 billion of credit, and that'll be one more turn. And so if you look at the formation of the credit networks, when the SEC took the handcuffs off of IBIT options, they were crippling the derivatives market for IBIT options on the regulated markets up until like a few months ago. When they first of all, they made it illegal to trade options for 4 years. Then they turned on the spot ETFs, and the spot ETFs grew to $100 billion in like 15 months. Then the options market got to 10 billion, and then in a couple of weeks it went from 10 billion to 50 billion. And so structural things like unhandcuffing or normalizing the options market, turning on, the CFTC just green-lighted native spot Bitcoin trading on the Chicago Mercantile Exchange, right? The CFTC just green-lighted it for regulated exchange in the US. And then they green-lighted the use of Bitcoin as collateral for those transactions. That's going to create 10, 20, 50 billion dollars of increased trading. So the structural changes by the regulators and by the banking and the trading establishment are way overwhelming the 4-year cycle, quote unquote, which is built into the protocol. And so at this point, the thing to be watching is the formation of the credit networks and the formation of the capital networks. And those are all decisions made by the commodities regulators, the securities regulators, the digital assets regulators, the banking regulators, and then watch the action of the big banks. Like Citi announced they're going to start to custody and issue credit on Bitcoin next year. Schwab announced they're going to do it. I think we'll actually see 8 of the 10 largest banks in the US do it in the next 24 months. When they come into the space, they're going to create $100 billion worth of credit each. And so the amount of, let me say it a different way. If you could not get a loan to buy a house in Miami or an apartment in Miami, what would the impact on the price of the real estate be? And if someone said, oh yeah, guess what? Banks are going to start giving you mortgages on houses but not apartments. Zip. And then they said, well, apartments. Zip. And if they said, well, now it's subsidized and it's going to be a conforming rate 200 basis points lower, prices go up again. And if you recall, what happened when Jerome Powell said we're lowering interest rates to 0, and the Fed regulators said that the reserve ratio for banks could go to 0 and they could in essence have unlimited leverage. And they said that in March of 2020. If you recall what happened to real estate prices? Yeah. So it's the credit networks forming and normalizing around this asset which are going to drive the asset class right now. And it's not the 4-year cycle. There are dynamics, but the dynamics have to do with the credit markets and the actual trading of it and the formation of derivatives and how they move.
Well, this is great. I think you've even orange-pilled some of our members in the audience. Let's give them a round of applause here.
You know, let me just close with a final thought, which is the big ideas are digital capital and digital credit. And if you have money you don't need for 4 years, you're gonna invest in some capital asset, whether it's real estate or private equity or public equity. And so if you believe in digital assets and if you understand Bitcoin, you'll say, well, I'm going to put some of my long-term capital into digital capital. If you don't trust anybody and you don't want to trust anybody and you want maximum optionality to take your money anywhere on earth to any custodian anytime, and if you want that capital to be in your family and pass it forward for 100 years, you buy digital capital. It's digital gold. It's a very simple idea. You don't have to self-custody it. You can actually leave it with a custodian. But you know that if you ever have to leave Florida and move to Wyoming, you can move it to Wyoming. And if you ever have to leave the United States, you can take it with you. And it'll not be a taxable event. It'll be a bearer instrument. So if you want maximum optionality and you've got a long time frame, buy digital capital. If you believe in Bitcoin, but you don't have a long time frame, you need the money in 4 months or a year or 4 weeks, or you can't stand the volatility, think about digital credit, because digital credit has a lot of that risk involved stripped off it. And you know, what people decide is really a function of, you know, what is your view toward what do you value in life and what stage are you at in your life and what's your investment mandate. But what I would say is you have a new asset class, digital capital. You have another new asset class, digital credit. Most of the world doesn't understand it. The very best investment ideas are something everybody needs, nobody can stop, and nobody understands, right? If everybody agreed that it was a good idea, it would cost you 10 to 100 times as much money, right? And so what you have is a set of new ideas. What this is going to cost you is not money, it's going to cost you time. You're going to have to spend 10 hours or 100 hours to form your own opinion. And once you form your own opinion, if you're a credit investor, you can make an obscene amount of money on these credit instruments. They're investment grade, but they pay like double distressed debt. And if you're a capital investor, you know, you can make a lot of money by doing the research and buying 10 years before everybody else tells you it's a good idea to do the thing. And if you're not comfortable, don't do anything you're not comfortable with. But I think this is it's a market with profound opportunities for people that are thoughtful and who are willing to consider the matter. So if you want more information, you can find a ton on hope.com. I think Bitcoin is hope, HOPE.com. You can follow me on X. I post pretty much every day, Saylor, my name. And I appreciate you guys, and thanks for your indulgence today, and all the best.
Awesome. Thank you very much.